Every quarter we also do what we call the rating breakdown on our ETF and mutual fund ratings by sector. And this is important because we want you to understand exactly how our ratings work. There's two key components. There's portfolio management, which is the quality of stocks that the manager holds, and there's total annual cost, which is the all-in cost of being in the fund. We're going to break them both down for you in this report. First, let's look at the best ETFs or mutual funds in each sector, as we see in Figure 1. Interestingly, we see in the consumer discretionary sector, a mutual fund gets top marks, but an ETF gets the top marks in the consumer staples sector. It's mostly ETFs that get our best rank, and that happens for a couple of reasons. One, we do see ETF stock selection is actually better than most active managers in the mutual funds, and their costs are always cheaper, which helps our rankings as well. Look, if the holdings are bad, it doesn't matter how cheap the fund is, right? So you got to make sure you start with good holdings, and then you hopefully get a good price with that as well. But certainly you don't want to pay a lot for a mutual fund or an ETF that holds bad stocks. One of my favorite stocks in the sector is Allstate. Great company, great profits, terrific growth in profits since the financial crisis. Its earnings were understated by an unusual charge in the last fiscal year, which makes it look less profitable than it really is. But the thing I like best about Allstate, which is great, is the low risk, because the valuation implies that the profits are going to permanently decline by 30%. I love stocks with low risk like that. Unlikely that Allstate's going to see a permanent 30% decline in profits. Buy this stock while it's still so cheap. Figure 2 shows the worst ETFs and mutual funds in the sector. Not surprisingly, mutual funds dominate the rankings here, only one ETF. Mutual funds tend to dominate these rankings because not only do they have bad stocks in a lot of these mutual funds, but their costs are outrageous. We see some mutual funds, when you take into account the full picture of costs, that are charging investors upwards of 9% compounded annually over a 3-year holding period, which is awful. Dow Chemical Company, ticker DOW, is one of my least favorite stocks in all the funds that are being held. It's held by the ICBAX, which is Icon Funds, Icon Materials Fund, my worst rated materials mutual fund. And it's the worst rated because it allocates over 81% of its assets to neutral or worse rated stocks. Almost nothing in the portfolio is going to the good stocks. I don't like Dow Chemical because over the last 8 years, it's seen a decline in after-tax profits, 3% compounded annually. Its return on invested capital has been dropping from 13 to 6%. And yet the valuation at $50 a share implies the company's going to grow profits, or NOPAT, by 10% compounded annually for the next 24 years. Those are high expectations. Why bet on a stock with expectations that high? Doesn't do anybody any good. Figure 3 shows the sector funds with the highest quality holdings. Again, these are the funds that have the best portfolio management rating despite what the cost may be. And again, you see about an equal mix here of mutual funds and ETFs. Figure 4 shows the funds with the lowest quality ratings. Again, an equal mixture of ETFs and mutual funds here. Again, quality holdings is what drives our ratings primarily. Figure 5 shows the sector funds with the lowest costs, and not surprisingly, this figure is dominated by ETFs. In fact, an ETF wins the lowest cost ETF or mutual fund, or the lowest cost fund for every single sector. And Figure 6 shows the sector funds with the highest costs. Not surprisingly here, these are all mutual funds. Again, the best detail into the underlying holdings and the costs on ETFs and mutual funds from New Constructs, and you get it every quarter in our quarterly series of the best and worst.